just hit it.
Well, hello, everybody, and thank you so much for joining us. This is basically our a follow-up, if you will, from the Life Sales Academy that we had, and everybody was interested in, well, maybe not everybody, but interested in having kind of a study group. And so what we really wanted to do, and the information we sent out prior to this was, we're going to kind of walk you through, we, meaning Scott, is going to walk you through several different scenarios for just a generic client. We think that this is a good starting point, based on the feedback that we got from the Sales Academy, to allow you to kind of see from all levels, if you will, the breadth of solutions, because we're not doing a product dive here. We're doing really just an idea of the different solutions that are out there for life insurance for just an average client. And so we've got this recorded. You can always come back and listen to it on demand. We're going to host it on our website. It'll also be on our YouTube channel. However you want to receive that media and you want to listen to this, it's going to be available to you. So without further ado, I'm going to turn it over to Scott Gilpin, and he's going to kind of go through, like I said, the breadth of solutions that we've got. And I think you're going to find this very interesting. So Scott, thanks so much for doing this, and I'm going to turn it over to you.
Thank you, Angie. I appreciate it. Like Angie said, what I want to do today, what I thought would be a good starting point is to simply take just a hypothetical client that you would have on any given day, and run you through some different product options, not necessarily to get away from just simple term insurance, but just to show you that what some of your options are when someone basically says, I would like a life insurance policy, or I need to buy some life insurance. So some of this is going to be a little elementary. We're going to start. I want to start with showing you the term quote engine on our website, and we'll start with term, and we'll just kind of work our way up, and I'll show you a few different options. So let's start. So the client that I have is we're just going to work on a 45-year-old female, preferred non-smoker, 250,000 face. So this is not, like Angie said, this is not a product dump. I'm not recommending what this client should buy. I'm simply wanting to show you what the options are for a 45-year-old female that wants 250,000 of life insurance. So obviously there are more options than term insurance, and we can get a little bit more detailed when we get into the permanent products of different options, even that permanent products don't have, or that they do have over term insurance. So let's just jump in real quick. Hopefully everyone is looking at our website, our Producers Excel homepage, and like I said, we're going to just start with a simple term quote. So if you've ever talked to me, you know the term quote engine that I like to use is under the quotes tab. It's the Term UL engine, and I'm going to try to go through some of this really quick because I know you don't want to sit and watch me type. We're just going to put in a valued client, and we're going to make her 45 years old, female. We're just going to pick our state. We're in Kansas, so we'll pick Kansas. I'm going to show a couple different term lengths on a 45-year-old. Again, you can do any number of term lengths, but we're going to pick a 15, 20, and a 30-year term just to show a few different options. And we said 250,000. That's kind of the ballpark death benefit that we're going to work with today. For her, I told you, again, I'm not getting into an underwriting conversation. Again, we're just going to assume preferred non-smoker on all these quotes. And that's all you do. You hit get quotes. And so on here, I'm sure all of you have seen our term quote engine, but if you haven't, very simple to use. We did a 15, 20, and a 30. You can see the tabs up here. You can just toggle between the tabs to see the different numbers. And of course, you have all your carriers. It gives the carrier the name of the product, the proprietary name of their product, the rate class, and the age, and the premium. So if you do want to change the mode of premium, you can simply change it up here, and it'll change for you very quickly. I'll tell you the reason why I always leave it on annual as a default, and I'll show you here in a minute. But as you scroll down, you can see all the different carriers and the different prices that they have. You can see that on a case like this, the margins are pretty thin between the carriers. The first 5 or 6 carriers, I mean, we're within basically $1. So on here, if you wanted to actually run the quote and send it to the client, or rather if you called me and said, hey, Scott, I need some term quotes, I'm going to show you exactly what I would send you. So again, I'm not caring about product right now. I'm just going to pick a few, and then I toggle over the 20. I'm going to just pick the top 3, and same thing on the 30. And then what we do is we go up here to where it says this compare button. I've selected 9 carriers to show the client or to you, and I hit the compare button. It separates out just the carriers that I selected, and then I go up here to the download button and I click on this one that says Comparison Ledger. And I like this one because I really like the view. It's very easy to look at. Hopefully it'll come up here in a second. There we go. So this is the view. This is what you see from me, and this is obviously what you could send to your client. It's very easy to read. You've got your 15-year tab and the carriers. And again, like I said earlier, the reason why I always leave it on annual is because the quote, when you get to this page, it has all of the modal factors, which is great because the client, as you know, can change their mind and ask you different modes. So all the different modes are down here. Here's our 15-year, here's our 20-year, and there is 2 pages, so we scroll to the 3rd page to get to the 30-year tab. So again, this is a simple term quote. I suggest you at least play around and know how to run term quotes. We certainly don't mind running your term quotes for you. I do it every day. We have no problem running them for you, but it is an easy process, and it's great for those times that maybe we're not available, or maybe you're working on a weekend or after hours. So it's a good thing to learn how to know how to do term quotes. But to get out of this, all you do is click out of the PDF. It takes you right back to this page. And if you wanted to adjust, change anything, all you do is hit the back to the results and then back to search, and you're right back at your home screen, and you can just change it if you want to change the face amount or the health class, etc. Okay, so again, simple term quotes, that's our starting point on this 45-year-old female. So now what I want to do is I want to go into some permanent options. WinFlex is on our website. This is the program that houses a lot of different carriers, and this is what I use whenever I'm asked to run a permanent quote. You can see, and I don't want to necessarily get into this, but on this TermUL engine, technically there is a GUL option on here. I'm going to just be honest with you. I'm not going to suggest you use it, and it's only because it's accurate, but it doesn't really show all of the carriers and the products that we have. And so again, for this conversation, I want to just say use this TermUL engine as just term. If you want any permanent products, again, you can always email us, and we will be happy to run those for you. We run the vast majority of permanent quotes for our agents. But if you want the ability, and again, with this group, I'm hoping that at least some of you will want to jump into WinFlex and register for WinFlex and run your own quotes, just to be a little more educated on how it works. So what we do when you want to go to WinFlex, and again, if you want to do this on your own, you certainly can, but your permanent quotes are always able to be run by us. We're happy to do it. So you go to the Quotes tab, you go down to the WinFlex option, and just click on WinFlex. Now I'm sorry, I went too fast. The download instructions are there if you want to register. So this is the WinFlex dashboard when you get into it. What you do is you click on the Illustrations tab. This phone call today, I'm not going to get too detailed into the inner workings of WinFlex. Again, this is more about just options for a 45-year-old female. Obviously, you can look and see what I'm doing, and if anybody wants a more detailed explanation of how to use WinFlex or what buttons to push to make a product do exactly what you want, by all means, call me offline and we can have that one-on-one conversation. So all I do is hit Start a New Case. And again, I'm kind of starting from term, and I'm kind of working my way up the ladder here. So what I want to do first is just run a simple guaranteed universal life quote. If you don't know, a guaranteed universal life is obviously a universal life. It's a permanent option, but it's kind of like term in the fact that it doesn't, the premium is level, the death benefit is level, assuming, that the premiums are paid on time and as scheduled and no money's taken out of the contract. That's always the little disclaimer that you need to throw on a GUL conversation. But it's kind of like term because there's really no cash accumulation, but it's a great option for someone who wants coverage beyond what term can provide. And we all know that term insurance typically will only get someone out to age 80, 85 at most. And guess what? A lot of people die after that. So if you want something permanent, something that someone can feel, very comfortable that they're not going to outlive, and you want coverage to age 100 or beyond, guaranteed universal life is a great and cheap option for that purpose. So that's what I'm going to show you first. I'm going to just pick on, again, I'm not recommending products. I'm going to pick what I like to use or what I'm comfortable showing you here today. So we're going to choose Protective Life, and the product on a simple GUL chassis is the Lifetime Assurance UL, this one right here. I'm going to hit Create Client. The first thing I do, I always go to the Agent tab, because if you try to run it without agent information, it's going to give you an error. So I'm going to just go ahead and put in my name. There I am. So now it's defaulted me in there. So under the Insured tab, I'm just going to put in a valued client, and I can't spell. And we're going to change this to a female. And again, I said 45. We're going to change this to preferred, state of Kansas, so we're good here. The Solve For tab, all of these carriers, if you get in here and start playing around, all of these carriers have a little bit different buttons, a little bit different terminology within the same program. And that's where, if I'm being honest, that's probably the reason why a lot of agents like us to run their permanent quotes for them, just because there is an education process here. But I can tell you, if you pay attention to the words and the questions that they're asking, it all becomes a little bit self-explanatory after a while. Maybe I'm taking that for granted because I've done it for a long time. But your Solve For tab is kind of the meat and potatoes of the Solve. So here we're going to say Solve For Premium. The Premium Solve option in this case, it's defaulted to minimum. That's the only option here, so that's easy. So we're going to change the face amount to $250,000, and we're going to say lapse protection duration to age. This is an important one because this is basically where you're telling the company, how long do I want the product guaranteed to? And so again, for this conversation, I always like to default at age 100. That's just me. Personally, I like to see 105 just because what are the chances your client could live to age 100 versus 105? There's a huge difference in those 5 years. So again, that's really for you and your client to discuss what they feel comfortable with. But let's be honest, if you're quoting a guaranteed UL, why would you want to quote it less than at least 95? Because, if you run it down to 90, what if your client lives to 91? So again, that's for you and your client to decide, but I like to default my GUL quotes to age 100. Policy options, it's defaulted to the guaranteed rate because it is a GUL. We'll change this to monthly just because that's probably what you'll see most often. Policy riders, I'm going to leave blank. I am going to get rid of this compare report. We won't get into that. I just don't like that report. And we're going to hit calculate, and we're going to see what this costs. And again, I'm not comparing this premium to the term premiums. This isn't about what's better for this client. It's just showing you the different options available to this client based on, what they tell you their needs and desires are. So I apologize. Some of this is going to take just a couple minutes just for calculation. So once it's complete, it'll have the little PDF here. This is what I look at. This is the illustration right here. $153 is the monthly premium for $250,000 death benefit. I always look at the tabular detail to make sure that the illustration was run the way that I wanted it to be and the way I told it. Sometimes you'll get surprised and you'll have to rerun it. Okay, so this is very easy to look at. There's your guaranteed death benefit all the way down. Here's your premium outlay. Most of these carriers will annualize the premium, so 153 times 12 is your 1836. It's just showing you it's very simple. Every single year, this woman's going to pay this premium, $153 a month, and she's going to have a guaranteed death benefit. And as you scroll, here's 90. We scroll one more page, and here we are at age 100. Just a default of how Protective works, they always show the illustration beyond age 100, but look at that premium. That's ridiculous, right? So you would essentially, this is a to age 100 and it's done. Because if this woman lived to age 101, she sure as heck is not going to pay $165,000 to keep it going. She will have paid, and if that's the case, she will have paid more into policy than she's going to get. So again, that takes me back to have a conversation with your client about how long they feel comfortable with the guarantee. And don't shortchange it, because the difference in premium versus 95, 100, and 105 is really not going to be huge. And again, those 5 years of the client living could be enormous to them financially if you cut it short. So again, this is just a simple GUL. I'll show you real quick. To get out of this, you just click the little X up here. It takes you back to your summary. And then what you do on this side, my side is pretty big because I run a lot of quotes. Yours, if you just start, would probably be right up here, but I'm going to go down to this client. I'm going to go back. I'm going to show you real quick just because it's easy. I'm going to change the product. If you want to change product, you go here. I'm going to pick on Pac Life. I'm going to show you their GUL really quick, and I'm going to fly through it just to show you how similar these carriers are. So I'm going to choose their GUL, update the client. I always ignore the error messages because I always like to go through each of the tabs anyway, and I'll fix them there. But certainly you can read those errors. So we still have, obviously I'm still in there as the agent. It retained the information about the client, female, 45, preferred non. The quote design, again, different carrier, a little bit different options on how it's worded. So here I'm going to choose the NLG premium, no lapse guarantee level premium option. There's my face amount. Again, a little different than Protective's, but just read it. It makes perfect sense. I want my no lapse guarantee duration. I want that to go to age 100, just like the Protective one. Premium duration, again, I want to pay to age 100, so age 100 in both these boxes. We have it defaulted on monthly. Obviously, no disbursements on this. Policy options, nope. So I think we're good on this, and we're going to hit calculate. So this is, again, just another carrier, their GUL. It's very, very similar to the Protective. All the GULs are kind of similar in how they work. Obviously, there's different prices with them, and really when I make a decision, if I get recommended to run a quote, generally speaking, I go with the cheaper carrier. But cheap is not always best. So underwriting niches, underwriting concerns is a big reason why I go to one carrier over the other. And again, sometimes it gets down to very cosmetic things like, is the carrier easy to work with? How is their application process? And all of these other things that go into recommending a carrier. But let's be honest, on GUL and term, price kind of wins the day sometimes. So we're going to look at Pac Life here. Their illustration is going to look a little bit different, but again, it's very similar to the other one. $166.97. So the Protective, I think, was $153, so slightly cheaper with Protective on this particular case. If we look at the tabular detail, right here, this starts age 1 or year 1. There's your $250,000 death benefit. There's your annualized premium outlay, pay all years, guarantee, stops at age 100. So again, kind of like a term policy to age 100. So that's a GUL. Again, that kind of completes what I wanted to talk about. Well, that's not true. I do want to back up and show you with any kind of permanent quote, specifically GUL, IUL, you do get into situations where someone wants to do a short pay scenario. So let's look at that. And I'm going to write, if you don't want to write this down, I will, this one, and I'll just stay with Protective on this, or excuse me, Pac Life on this particular quote, just because. So $166.97 is the monthly premium on this particular case. and this was an all pay. So paid age 100, guaranteed to 100. So if I get out of this and I want to do a short pay, let's say the person just doesn't feel like they want to pay the premiums for, into their retirement years. So all you have to do here under premium duration is change it to whatever you want. If one of these ages isn't what you want, you can just do policy year or age. So in this case, let's just do a simple 20 pay. So this person's 45. She wants to pay the premiums at 65, so she's done when she starts getting into retirement years. We're going to do age 65. And again, I could have done policy year 20, would have been the same thing. And we're going to hit calculate. And there's other reasons to do short pays than just, hey, I don't want to pay premiums when I'm 70 years old. A lot of times there can be a premium savings by doing this. And I guess we'll check that. I didn't check this beforehand, so we'll just do the math and see if it works. So now our premium obviously is going to be more expensive because we are short paying it. So it's $270 a month, $270.43 a month. And again, I always like to look at the tabular detail of the illustration to make sure it did what I wanted it to. There's our 20 pay. It's very easy to, and that's what I love about guaranteed UL illustrations. They're very easy to look at and to explain. Year 1, year 20, there's our premiums, 0 premium thereafter, but our death benefit continues to be guaranteed all the way to age 100. So let's do the math real quick. So we already did the math for us on this one. $64,903 is the cumulative premium that this person would pay to get $64,000 to get $250,000. On the other one, I'll do the math real quick. $167.97 times 12 times 20. That's 40. Hang on. 166.97 times 12 times 20 years. 40. Wait a minute. I gotta think about $270.43 times 12 times 20, 64. Doesn't make sense to me. I'm sorry. I probably shouldn't have went down this road. 270. The other one, I want to check that. But regardless, that's how you do a short pay. I do want to look at that because that doesn't make sense to me why an all pay. Yeah, and if I get stuck on this, I promise you that we can circle back to this, but in most situations doing a short pay, oh, I know. I know what I was doing. Okay. I know why. And I'm so sorry. Okay. So when you do a short pay, the way that I usually explain this, and here's the 166.97. I'm sorry, I had a little brain lapse there. So the way I explain the cumulative savings on a GUL in this scenario, so again, we already did the math. It's $64,000, $64,900 for the 20 pay. And that's how much premium she would pay into the contract to get $250,000 guaranteed all the way out to age 100. So what I do is I say, let's assume that the person lives to a very realistic age 90, okay? Age 90. So 90 minus 45 years old is 45 years, right? So 45 years of premium payment, and assuming the woman passes away at age 90. So now we do our math on the 167. I'm sorry. 167.97 a month times 12, and then times that by 45 years. Now that's $90,163. Sorry, guys, I totally had a brain lapse on that when I was doing that. So when you think about it, if you say to yourself, hey, this 45-year-old female that's in preferred health today, very realistically, we're just going to assume she lives to age 90 and then she passes away, which I don't think is unrealistic at all. Obviously, accidents can happen, medical diagnoses can happen, and she could pass away a lot sooner than age 90. But again, Why, if we're doing a guaranteed UL quote, we're thinking long-term anyway. She's 45, she's in good health. Why would we just automatically assume she's going to die anytime real soon? Again, that's why I use age 90. So again, the math again, 90 years old minus her current age of 45 is 45 years. If she paid the smaller premium of $166.97 a month, and she paid that for 45 years, she will have paid over $90,000 into the contract for her death benefit to be paid out to her husband in this case. If she did the short pay and she paid it up in 20 years and she still died at that age 90, she's only paying $64,000. That's a very significant savings to that client. And guess what? She'll never see that if you don't offer it, or if you don't at least explain or show her that a short pay option is available. And the reason why it works is because there's no fluff. You can show them right there the math on the illustrations. You can show the short pay and the all pay side by side, and you can explain it just like I did without the brain lapse. If she lived to age 90, what the savings would be. And it's significant. And it really just comes down to, can she afford? Because again, anybody would understand the savings. They would see the benefit of doing the short pay. So really it just becomes, can she afford it? And sometimes you don't know what people can afford or what they're willing to pay unless you talk to them about it and you show them the savings. Unfortunately, sometimes we're treated a little bit like a car salesman, and nobody ever wants to tell us what their budget is, or they want to downplay it. So again, a simple showing this person a short pay option, even if they didn't ask for it, they might just wide eye and go, holy smokes, this is a great savings. That's a great option, and I want to do it. So you make a sale. And again, this isn't about commission to you. This is literally about savings to the client and doing a better job for the client. Okay. Okay. Sorry, that took longer than I needed to because I didn't figure out the math. Sorry. Okay. So we're going to move on here. We're going to go to, and by the way, sorry, I don't want to move on because I want to show you one other thing. If you wanted to, when you talk to your clients, hopefully you're always discussing with them or asking them about any existing coverage that they have. If they have existing coverage, you have to know about it anyway because you're going to have to indicate it on the application. But you also want to verify if they have any permanent coverage, is there any cash value in that other policy, and is it something that we could use for a 1035 exchange? So again, let's just show that real quick. I'm going to take this back. We're already on age 100. Age 100, we're going to kind of go back to our starting point. But we're going to assume in this case that this woman had told you that she had a whole life policy that her parents bought her a long time ago, and she double checked, and there's cash in that policy. Let's say the cash surrender value. So if she surrendered that contract, the cash available to her would be, in this case, let's just say it's $20,000. Okay, which is not unrealistic if she had a whole life for that long. So what we're going to do here is we're going to do the exact same quote, but we're going to just put in that 1035 amount. So under the 1035 exchange amount, we're going to put in $20,000, and we're just going to run the quote, and we're going to see. Now, this is the one that's comparing the 167. So I know that when the illustration comes up, the premium is going to be cheaper than $166.97 simply because we're dumping in that $20,000 of cash from that other policy. So now her premium is only $91.59, and right there it shows the 1035 exchange of $20,000. And again, when you look at your tabular detail, it'll show right here in one. So there's the $20,000 plus her monthly premiums over the year. And again, you still have your $250,000 guaranteed to age 100. So what's the value of this? Obviously, her premium is lower to get this $250,000 guaranteed to age 100. And this is obviously assuming that the other policy, maybe it's maybe it's not a great policy, maybe it's underperforming, maybe the premium's too high. There's a lot of reasons why you can do a 1035 exchange. Just because somebody has another policy doesn't mean that it's you have to do it or you should do it. Some people have great policies and they're performing well and they should be left alone. But again, we run into a lot of scenarios where somebody has a policy that they've been paying on for years and years, and they want to not pay any premiums anymore, and they want to know what they can get for just the 1035 amount. And again, there's a lot of different options. We can do single pay and all kinds of things. But the point of what I want you to take away from this is, when you're talking to your clients, always ask them about existing coverage that they may have, especially anything that might be permanent and have some cash. Okay? Okay, the last thing I want to show you on GUL, and I'm picking on GUL just because I'm already in it. This can be used on on IUL as well, which I'm going to show you next. But there is you've heard us talk about living benefit riders, and the one that we run most often, or we see most often, is the chronic illness rider, and that's what I want to show you that real quick on this. So I'm going to take this $20,000 out. I want to get back to kind of our original quote. This is the $167.97, same $250, same guarantee to age 100 and pay to age 100. Okay, but now what I want to do is I want to add a chronic illness rider, and just very briefly, a chronic illness rider is a rider that you attach. It is a cost rider. But what it does, in essence, is it takes the death benefit and it turns that into a pool of money that can be used if the person becomes chronically ill. Chronic illness rider is very, very similar to a long-term care rider. The triggers are the same: not being able to perform 2 out of 6 activities of daily living or having a severe cognitive impairment. And with a 90-day elimination period. So if someone is, well, let's run it first and then I'll explain it. So same client, we're going to go to our riders tab. We're going to click on the chronic illness rider, and we're going to make this, there's a 2% option and a 4% option. And that percentage is simply based off of the death benefit. So if you have a $250,000 death benefit and you do the 2% option, that's $5,000 a month that they could accelerate out of their contract if they become chronically ill. Now, if you know anything about long-term care at all, $5,000 probably not enough right now. It's better than nothing, but it's certainly not enough for nursing homes. And of course, that's all dictated by geography and where and the quality of the facility and et cetera. But on a $250,000 face amount, I would definitely recommend a 4% option. 4% would be $10,000 a month. That's much more in line with, that's actually probably a little bit under, but it's where we should probably be if we're running this. So we're going to choose the 4% option, and we're just going to, that's all we need to do. We just add in the rider. So let's take a look at the illustration first, and then I'll explain a little bit more how it works. It's very simple to understand. That's the beauty of these chronic illness riders as well, is because not only are they really not that expensive to add to the contract, but it just adds a whole nother element of benefit that they didn't have access to before. So now we look at the illustration, and again, our original quote was $166.97 a month. So now what we do, we change the premium is now $211 because it is a cost rider. So what is that? 211 minus 167, that's $44 a month extra that they're going to pay every single year in order to have a $250,000 pool of money that can be used as a living benefit to them if they get sick, versus just a death benefit if they die. So there's really not much more to the illustration. There is a section here, and it says kind of what I just mentioned. $250,000, it's a 4% rider, so the maximum monthly benefit that this client can get is $10,000 a month. And the beauty of it is that's a dollar for dollar reduction from the death benefit if they go on claim. So if this woman had this policy, she's paying her $211 a month. She's, let's say 20 years go by. She's been paying her premium every month, and everything's working exactly how you illustrated it. This woman has a massive stroke at age 65, and now she can't do 2 out of 6 activities of daily living. She goes to her doctor, she gets a certification from the doctor that she's chronically ill, she can't perform these ADLs over the next 12 months, and she sends in the claim work to the carrier. Again, 90-day elimination period. They just start giving her the $10,000 a month. That $10,000 that she gets accelerated to her is subtracted from the $250,000 pool of money. And every single time she gets a payment, it's just a subtraction off that death benefit amount. That $10,000, it's indemnity. Most chronic illness riders are indemnity, so the money can be used for whatever she wants. She could use it for a family member to help her, home health, nursing home. She could go on a vacation with the money. It's indemnity, so once you qualify, you can get it. The one thing about a chronic illness rider is, in this case, if she had, let's say she had that stroke, let's say it was pretty mild, she needed help, but maybe she only needed $5,000 a month instead of the 10. She can take less than the 10, she just can't take more. So if she took less because she doesn't need the full 10, what she's really doing is allowing the pool of money to last longer. That's simply it. In this scenario, in a hypothetical scenario where she goes on claim and let's say she's accelerated $100,000 of this pool of money and then she passes away, the remaining $150,000 balance would be paid out as a death benefit to her beneficiary. So that's the quick and short of a chronic illness rider. Again, if you guys want to dig any deeper, you can certainly call me and we can have a one-on-one conversation about that. So those are some of the options when you get into permanent quotes. And again, I'm not going to do all of these different options on the IUL, but you can do short pays, 1035, and chronic illness rider with the IUL as well. But it was just an easier thing to illustrate on the GUL, which is why I wanted to talk about it first. Okay, so now I'm going to show you real quick an IUL quote. Just again, as a different option. This is an option that I would say is looked at when, I don't know if this is the right way to say it. I kind of say it sometimes. IUL is kind of like having your cake and eat it too, because you get good. It's a permanent option. You have good long guarantees in it that are kind of similar to GUL, but you also have some cash accumulation growth. So that's kind of why I say it's kind of a have your cake and eat it too kind of situation. So I'm going to pick on, I'm going to change the product. I'm going to go to Protective. I'm going to pick on their product, the Index Choice. And, okay, I'm going to clear my errors. So I still have my 45-year-old female preferred in here. I'm going to do a Sol 4. And again, Protective, this is just a kind of a specific thing with them. But you kind of have to back into the premium, and I'll explain this a little bit more when we get into it. But we're going to do a lapse protection solve. I'm going to do age 100, and it's kind of weird because that's not really what's going to happen on this, but I'm going to show you how I back into this. 250,000. Index strategy, we're obviously indexed. We're going to put 100% into the indexed account for obvious reasons. I mean, if you're doing an IUL, my recommendation is it should go into the indexed account. You certainly can do a 50% indexed, 50% fixed. It makes more sense, in my opinion, to do 100% in the indexed account. Illustrated rate current, no disbursements, policy options, we still have it on monthly. Okay, so let's take a look at this. And again, this is specific to Protective. And again, if you guys are never going to run these things yourself, then this is a little bit more than you probably need to know. But I'm going to explain why I back into it and why I changed the premium. This is a personal philosophy that I have and kind of our office has when it comes to Index Universal Life. The one thing that I strongly recommend you don't do when you run these or when you sell these is to underfund them to a point where your client's going to be upset in the future. Now, obviously, with an index product, there are a lot of non-guarantees and things can fluctuate over the years. That's just the nature of this product. But you and I can do some things on the front end that can hedge against the possibility of the client not being happy or needing to pay more premium. So the first thing I want to do is I want to look at this. Look at this quote. The quote is very similar to the GUL, but there's some differences in the tabular detail, and I'll explain it right here. So I'm not going to get caught up on this premium because that's really not the premium that we're going to pay on this, and I'll tell you why. So when you look at it at the illustration, and again, I don't want to go super deep into this. Again, we can talk about this one-on-one if you want to dig deeper, but on a index UL, you have three columns to the illustration: your guaranteed assumptions, your non-guaranteed midpoint assumptions, and then your non-guaranteed what we call current, what the current interest rate is. So the guaranteed assumptions is what I like to call worst case scenario. It's basically assuming zero interest every year and maximum policy charges. And let's be honest, that's not going to happen. The one thing that I can pretty much guarantee you is they're not going to charge maximum policy charges from day one. Obviously, I certainly don't expect the S&P to return zeros every single year after year after year on this. So I would say with a lot of certainty that I would pretty much guarantee you it's not going to be 0% every year. But again, the guaranteed assumptions column is important because it shows you worst case scenario. And I think that's very important on any kind of indexed product, that you at least look at this side. So maximum charges, zero interest, this is what is expected to happen. And these charges and 0% is basically an every year calculation, because the illustration, of course, can't fluctuate with the times. It can only tell you, it can only base its numbers off of, set numbers. So this is the guaranteed worst case scenario column. The middle column is what we call the midpoint. It's using a more conservative interest rate than the non-guaranteed, this column over here on the far right. So in this case, it's using a 3.5% interest, so it's calculating 3.5% interest every single year, and it's using current policy charges, so the current cost of insurance and current mortality charges. This is the column, quite frankly, that I really focus on because it's conservative. And sitting in our chair, we need to be conservative. I suggest you do the same because, again, we want our clients to be happy. So the midpoint, this is the column that I kind of pay attention to. And whether I say it wrong or not, the far right column is using, obviously, current charges, and it's using the default interest rate that the carrier puts out. So in this case, it's 5.55%. So this, I don't want to call this pie in the sky because that sounds like it could never happen. But this is the what I would call, I don't know, best case scenario. Now, obviously, if the interest credited to the contract year after year, if we're just in a boom for a long time, and it actually credits more than 5.55%, then this column is going to actually look better than it does on this illustration. The reality is, again, I can't tell the future. I don't have that crystal ball, but the reality is I think that our numbers would probably fall somewhere in the middle of these two columns. So let's look at this. As we scroll down, we see that our $250,000 death benefit is guaranteed all the way to age 90. With Protective, it's just a byproduct of how they work in their illustration software. They're never going to show the death benefit going beyond age 90 on their illustration. But let's be honest, age 90 guarantee, assuming zero interest and maximum charges every year, is very, very safe, in my opinion, very comfortable. But this column is the one that I really focus on. And I personally like to see the death benefit of be at least to or beyond age 100 in this column. So you can see with our default solve in this case, it didn't quite get us there. This column is, again, it's great. It goes all the way out to age 116. That's all fine and dandy, but this is the one I'm worried about. I don't like the fact that this doesn't go to age 100, so I'm going to change it. So I'm going to go back, and I've cheated a little bit. I already got this number because I didn't want to spend too much time going through this, but on the index, on the solve for tab, I'm going to change this to a no solve because I want to put in the premium that I want to pay. So 250,000, and again, I cheated. I already know the number. $170 gets us there. So let's take a look at that. Everything else is the same. And the way that I typically do this without cheating is I pick a number that's higher than $141, and I see how far it goes on the midpoint. And if it doesn't get me to age 100, I keep pumping the premium up. Now, I want to stress that this is me. This is my personal philosophy and kind of the philosophy of our office of how these things should be run. So it does not mean that you have to do that, but again, we want to be careful when we run index ULs, just so the client is happy down the road. So let's wait for this to calculate. I'm hoping it won't take too long. Now, there are other indexed ULs that can guarantee the death benefit to age 100 on the guaranteed side, which is, again, very similar to a GUL, but they're going to, it's going to cost more. So let's look at the tabular detail on this one. Same everything. We know that the premium's 170 because that's what I inputted. So let's look at this midpoint. Now our midpoint goes to age 100. And again, I told you I cheated and I put in 170 and it just ironically got it directly at age 100. If this was age 101 or 102, I wouldn't care and I would still send out the illustration just like that because I'm not going to nickel and dime the premium to get it exactly to age 100. I feel more comfortable if it gets there. So again, in this scenario, we're assuming that the current policy charges and a very modest 3.5% interest. If this policy performed at 3.5% every year, which of course it won't because it's not going to be the same every year. There's going to be highs and lows with an indexed UL. You might get a 6 or a 7 one year. You might get 3 in the next. You might get 0. You might get 4. That's how IULs work. So assuming 3.5% every single year, which again, in my opinion, is fairly modest and achievable, and the current charges, our death benefit goes to age 100. And again, remember, worst case scenario, we're still out to age 90. So if this client, dies before 90, we still have good long guarantees. Age 90 guarantee is still very strong in an IUL for sure. And then on the far right-hand column, you've got all your pie in the sky and look at what the cash does, et cetera. So that's essentially an indexed UL. I kind of look at it a little bit like have your cake and eat it too, like I said before. And so when you look at this, if you were going to talk to the client, GUL, what do we do on GUL? We were at $153 a month with Protective. With PAC, we are at $166.97. And on this one, we're at $170. So what's the difference? Same death benefit. The big difference is the GUL, and again, we'll pick Protective's GUL because it is cheaper. $153 a month guarantees the death benefit to age 100, and there's 0 cash. On this one, you pay $170 a month. You have very strong guarantees to age 90, but you have the benefit or the option of cash in the future for rainy day money. Now, we're solving this, and again, I don't want to get into max funding LERP type sales. That's not what this call is going to be about. This is just, again, showing you some different options. But again, would your client be willing to pay a little bit more premium to have this potential of cash accumulation growth? So again, under very modest 3.5% midpoint numbers, there'd be $41,000 of cash in 25 years at this person's age 70. Again, according to the illustration, it's not going to be that because things are going to fluctuate. But again, midpoint 41,000. If it performed as well as this column, the 5.55% each year, they'd have 55,000. Now those numbers might not blow your skirt up, but it's better than a zero, right? And you're only paying a little bit more premium to have the potential for some cash accumulation if something happens in the future. So the next thing you might ask is, okay, well, what if I want the cash to look a little bit better? Really simple. Let's just bump the premium up. You know, we put in $200 a month, and we know that the midpoint's going to go longer than age 100, and we know that the far right-hand column is going to go all the way to age 121. But all of these numbers here, all the cash value numbers, are going to be higher because you're paying more premium. So again, if you want your IUL to perform a little bit better, you simply put in more premium. I kind of did a solve for minimums, kind of like a comparison to a GUL. I didn't max fund this. Obviously, that wouldn't be fair to a GUL to compare. So that's Index UL. We'll move on real quick. I know I'm kind of running long here, so I'm gonna just do one more product to show you, and then I'll shut it down. So the last one I want to show you is Whole Life, another permanent option, a little bit different than the way it works, but we're going to change this. And again, I know I'm running long, so I'll make this quick. So we're going to choose MassMutual. We're going to just pick their Whole Life 100. I'm going to get a lot of error messages here because they're weird. I need to put myself back in here. Just they're kind of different on WinFlex. Okay, so we're going to go to our insured tab. We got our female. She's 45. Their preferred is basically called Select Preferred. The design, we're going to simply do a monthly premium, $250,000 face. The dividend options, default paid up additions, that's very common. That's probably 99% of Whole Life is the dividend option is paid up additions because that's what bumps the death benefit up as it goes on. We're not going to do any riders, and we're just going to see what this looks like. And by the way, really quick, I didn't want to do that. I was going to do this, but I'm running long. American General Corebridge has an IUL that does guarantee the death benefit to age 100 on the guaranteed side, if that is important. I discussed that a minute ago. Age 100, and I ran that number, and that number was $242.57 a month. So it was quite a bit more expensive to get that guarantee all the way out to age 100. But I just wanted to let you know that if that's important to you or the client, to show that 250 being there to age 100 on the guaranteed worst case scenario side, we can do it, and we do have a product that can do it. There will be a little bit more premium paid to get those guarantees, but I wanted to let you know about it. Okay. So on this one, I'm going to get past the supplemental illustration. So here's our quote. So 45-year-old female, preferred non, it's $360 a month for the $250,000. And when we look at the tabular details, same thing. We always want to look at that. And it shows right here, Whole Life's a little bit different animal, and I'm not going to go to a lot of explanation, but it does have a guaranteed side and a non-guaranteed side, kind of like the other products or the IUL. I think most of the time, you know, the Whole Life is going to be the most expensive permanent option. And the reason most of the time, again, the margins can be different per the client, but generally speaking, the premium is going to be more, but the values, the cash values and the growth is going to be a little bit more strong on a Whole Life than it is on an IUL. And again, that can be a little bit different. It can be very close at times. It just depends on the specs of the case. But the big draw to a Whole Life is the guarantees. These are guaranteed numbers over here, guaranteed cash, guaranteed death benefit. So as long as this person pays this premium, these cash value numbers are guaranteed. And a lot of people will say that a Whole Life policy is very, the dividend scales are very stable, not as fluctuating as an IUL could be. So, and of course, MassMutual is a very, very strong carrier, been around for a very, very long time. I think over 100 years. So they know their business. They're a very strong Whole Life carrier. So This is a very good product. Your client's going to pay more, but it's not without benefit. So they're going to get good, strong guarantees and good, strong cash value in a very good, reputable carrier. And we have other carriers, but I like to pick on MassMutual here. So again, I ran right up to an hour. I apologize. I really didn't mean to go this long, but I just wanted to show you all kind of what your options. If a 45-year-old female came into your office and said, "Hey, I'd like to buy some life insurance," and you wanted to run through the different options of what you have available to this person, this is what I would say you do: term, GUL, IUL, and whole life. And of course, we're not going to talk about final expense and all those weird things today. This is generally what we run on a daily basis when we get calls from y'all asking for quotes. So I hope this was helpful. Again, please call me one-on-one if you have any additional questions or if you want to dig deeper into any of this. I'm just going to tell you my direct phone number is 785-309-2934. That's my direct number. If you wanted to call our office toll free and then just ask for me, that's 800-541-6705. And if you know me, you probably already know my email address, but I'll tell you it's Scott, SCOTT, @producersxl.com. So with that, I will end this, and I appreciate y'all being on the call, and I hope to hear from you, and we can run some quotes for your clients. The one thing I'll tell you is think about the different options. If any of this was new to you, think about these different options and just try to think about maybe some clients that you've talked to recently or clients in your book that some of these products might be a good fit for, especially when you get into the chronic illness rider, the living benefit. A lot of clients don't know that these things even exist or that are even available. So, that's what they lean on you for, is to educate them and provide them good options and flexibility. So again, thanks to all of you for joining, and I hope to hear from you. Thank you.